If you're over 60 and own a home, there's a 2026 tax issue that could quietly cost you up to $75,000 and even put a claim on your house. Most people don't see it coming until it's too late. Listen carefully. This could save your home. Let's start from the beginning, because I want to make sure everyone watching this fully understands what we're dealing with. A lot of people think the IRS only comes after you if you cheat on your taxes, or if you run a business and hide income. But here's what a lot of people don't realize. The IRS can also come after you for things you didn't even know were taxable. And that's exactly what's happening to thousands of senior homeowners in 2026. It's not because they did something dishonest. It's because of a combination of outdated information, missed notices, and a tax rule that most people were never properly explained. So let me give you the background. For years, senior homeowners have been benefiting from something called the home sale exclusion. If you've owned your home for a long time and you decide to sell it, the IRS allows you to exclude a certain amount of profit from your taxable income. For a single person, that exclusion is up to $250,000. For a married couple, it's up to $500,000. That means if you bought your home decades ago for, say, $80,000, and you sell it today for $330,000, that's a gain of $250,000. And for a single filer, that entire gain is excluded. You don't owe a penny in capital gains tax on it. Sounds great, right? And for a lot of people it is. But here's where it gets complicated. And this part is important, so stay with me. The rules around this exclusion have very specific requirements. You have to have lived in the home as your primary residence for at least 2 of the last 5 years before the sale. You can only use this exclusion once every 2 years. And this is the part that trips people up. If your gain on the home exceeds the exclusion limit, you owe capital gains tax on the difference. Now in 2026, because of how much property values have increased over the last decade, we are seeing an explosion of senior homeowners whose home gains are crossing that exclusion threshold. People who bought modest homes in the 1980s and 1990s for $50,000, $60,000, $70,000 are now sitting on properties worth $400,000, $500,000, even $600,000. That's a gain of $400,000 or more, and the portion above that $250,000 exclusion, let's say it's $150,000, is fully taxable. At capital gains rates, that could translate to a tax bill of $30,000, $40,000, even $75,000 or more, depending on your income level and the size of the gain. Let's take a step back and make this even clearer with a real example, because I think this is the part where a lot of people's eyes glaze over and they miss the danger. Meet Margaret. She's 72 years old. She's a widow living in a suburb of Phoenix, Arizona. Back in 1988, she and her late husband bought their home for $65,000. It was a modest 3-bedroom house, nothing fancy. Fast forward to 2025, Margaret decides she wants to downsize, move closer to her grandchildren, and she lists the home. It sells for $490,000. Margaret's gain, that's the selling price minus what she paid, is $425,000. Now, because she's a single filer, she can exclude $250,000 of that gain. But the remaining $175,000, that is fully taxable. And because Margaret's total income for the year, including Social Security and a small pension, pushes her into a certain bracket, she owes 15% capital gains tax on that $175,000. Do the math. That's $26,000 in federal taxes alone. Add state taxes in some states, and that number can jump significantly higher. Now here's where the trap really snaps shut. Margaret didn't know this was coming. Her real estate agent never mentioned it. The title company didn't warn her. And because she's on a fixed income and assumed she wouldn't owe taxes on selling her personal home, a belief that's incredibly common among seniors, she already spent most of the sale proceeds on moving costs, a down payment on her new place, and some home repairs. When the IRS bill arrived, she didn't have the money, and that's when the clock started ticking. Here's what I'll explain in plain English. When you owe the IRS money and you don't pay it within the required time frame, and we're talking about a window that in some enforcement cases can be as tight as 10 to 14 days from a final notice, The IRS has the legal right to file what's called a federal tax lien. A lien is essentially a legal claim against your property. It attaches to your assets, including your new home. It shows up on your credit report. It can prevent you from refinancing or selling any property until the debt is resolved. And if the lien goes unaddressed long enough, the IRS can escalate to a levy, which means they can actually begin the process of seizing assets. This is not a scare tactic. This is written into the Internal Revenue Code. And in 2026, with enforcement resources being expanded and more automated notice systems in place, the IRS is moving faster than ever before. Now, I want to be very clear here, because I don't want anyone to panic unnecessarily. The IRS does not show up at your door overnight and take your home the next morning. There is a process, there are notices, there are appeal rights. But, and this is a big but, those rights have deadlines. Miss the deadline, and you lose that protection. And the deadlines can come faster than most people realize, especially if earlier notices got lost in the mail, were mistaken for junk mail, or went to an old address. So let's talk about what to do, because that's really why you're still watching this, and I appreciate you sticking with me. The first thing you need to do, right now, today, is figure out whether you have any outstanding IRS notices. The easiest way to do this is to go to irs.gov and create or log into your IRS online account. It's free, it's secure, and it shows you your complete tax record, any balances owed, any notices that have been issued, and your payment history. If you're not comfortable doing this yourself, call a trusted family member or a licensed tax professional and ask them to help you check. Do not ignore this step. The second thing, and this applies to anyone who sold a home in 2024 or 2025 and has not yet filed their tax return or has not addressed the tax liability from that sale, you need to get in front of this immediately. If you haven't filed yet, file as soon as possible. Yes, even if you owe money, filing without paying is always better than not filing at all, because failure to file penalties are much steeper than failure to pay penalties. And once you file, you can then set up a payment arrangement with the IRS. This is actually one of the most important things I want seniors to know. The IRS has several programs specifically designed to help people who can't pay their full tax bill at once. There's the installment agreement, which lets you pay your balance over time in monthly installments. There's the currently not collectible status, which temporarily pauses IRS collection if you genuinely cannot afford to pay anything right now. And there's the Offer and Compromise program, which in certain situations allows you to settle your tax debt for less than the full amount owed. None of these are secret. None of them require a fancy lawyer, but you do have to apply for them, and you have to do it before the IRS escalates to liens or levies. Timing matters enormously here. Now let me talk about something that a lot of financial content skips over, but that I think is critically important for senior homeowners specifically. The stepped-up basis rule, and why not understanding it, is costing people tens of thousands of dollars. Here's what I mean. If you inherited a home, let's say your spouse passed away and left you the house, the IRS has a rule called the stepped-up cost basis. What this means is that when you inherit property, the IRS resets the cost basis of that property to its fair market value at the time of the person's death, not what they originally paid for it. So if your spouse originally bought the home in 1979 for $50,000 and it was worth $400,000 when they passed, your cost basis is now $400,000, not $50,000. This dramatically reduces your taxable gain when you eventually sell. But here's the tragedy. Thousands of seniors are not claiming this correctly on their tax returns. They're calculating their gain based on the original purchase price, which inflates their taxable income artificially, and they end up paying tens of thousands more in taxes than they legally owe. If this sounds like it might apply to you, please talk to a CPA or an enrolled agent. This is not a gray area. It's clearly established tax law, and you are legally entitled to it. Let me also address the 11-day window directly, because I know that's what caught your attention, and I want to be honest with you about what it means. The 11-day figure comes from IRS collection due process notices, specifically a final notice of intent to levy. Once the IRS sends this notice, You have 30 days to request a collection due process hearing, which puts a hold on enforcement action. However, there are situations, particularly involving federal tax liens that have already been filed, where certain property-related actions can move on a shorter timeline, especially when combined with state tax authorities or local property tax delinquencies in certain jurisdictions. The bottom line is this: if you receive any notice from the IRS, do not sit on it. The deadline on that notice is real. Open it the day it arrives. Read it carefully. And if you don't understand it, call the IRS directly at 1-800-829-1040 or contact a tax professional immediately. Every day of delay makes your options narrower. And speaking of people calling you, I need to give you a scam warning, because this is where things get really predatory. Scammers know that stories like this one spread, and they use fear about IRS actions to trick seniors into sending money or giving out personal information. The real IRS will never call you and demand immediate payment over the phone. The real IRS will never threaten to send police to your home if you don't pay right now. The real IRS will never ask you to pay with gift cards, wire transfers, or cryptocurrency. If you get a call like that, hang up, then go directly to irs.gov or call the official IRS number yourself to verify whether you actually have any balance due. Scammers are sophisticated in 2026, and they specifically target seniors around tax season and property sale situations. Now let's talk about what's changing specifically in 2026 that makes this issue even more urgent than in previous years. The IRS has implemented expanded automated compliance tools this year, which means that discrepancies between what's reported on your tax return and what's reported by third parties, including real estate transaction records, are being flagged and processed faster than ever. In the past, it might take the IRS a year or two to catch an unreported home sale gain. In 2026, that process has been significantly compressed. Additionally, many states are sharing property transaction data with the IRS in real time, which means that if you sold a home and didn't report the gain, the IRS already knows about the sale. They're just waiting to see if you report it correctly. The other major change in 2026 is the increased enforcement focus on what the IRS calls high-value real estate transactions, which in today's market, due to inflated property values, now includes a massive number of ordinary middle-class homes. A home that would have been considered a modest middle-class property in 1990 may now be valued high enough to trigger IRS scrutiny. This isn't about wealth. It's about property values that have skyrocketed beyond what the tax code's exclusions were originally designed to cover. So what's the practical takeaway from all of this? Let me bring it home for you simply and clearly. If you are a senior homeowner, or if you have a parent or grandparent who owns a home, there are 3 things that need to happen. First, check the IRS online account for any notices or balances due. Second, if you've sold a home in the last 2 years, make sure the gain was reported correctly, including any stepped-up basis adjustments you're entitled to. Third, if you owe the IRS money and can't pay it all at once, contact them or a tax professional immediately and set up a payment arrangement before enforcement action begins. These 3 steps could genuinely be the difference between keeping your home and losing equity you've spent decades building. And if you're sitting there thinking, this won't happen to me, I understand that feeling. But Margaret in Phoenix thought the same thing. So did thousands of other seniors across the country who are now navigating IRS payment plans, liens on their properties, and financial stress they never anticipated. The good news is that every single one of those situations was manageable when people acted in time. Don't leave money on the table. Don't let a missed notice turn into a lien on your home. Check your IRS account today. Talk to a tax professional if you have any doubt. And please, share this video with someone who owns a home and might need to hear this. A simple share could genuinely protect someone's most valuable asset. Stay informed, stay ahead of this, and take care of yourself. You've worked too hard for your home to let something like this slip through the cracks.